Hello and welcome to Livewire's listed series for 2026, where we're helping investors build portfolios for a changing world. My name is Chris Conway and today I'm joined by Nick Griffin from Munro Partners. Nick is going to be talking to us about how he's navigating today's market via the Munro Concentrated Global Growth Active ETF, trading under the ticker MCGG. Nick, welcome to Livewire's listed series for 2026.
Thanks very much for having me.
Growth is often synonymous with change, which the world, as you know, is experiencing quite a lot of right now. What are the biggest change agents in your space and how are you navigating them?
Look, our job effectively is to identify the big structural changes in the world and identify the winners. That's actually been happening for a long time, right? So, you know, we could all remember when we used to carry cash and now we pay everything with card, and that drove Visa and MasterCard along. We can all remember when we used to read newspapers and now we read our telephone, and that drove digital advertising, Facebook and Google along. If you take that context, the big change at the moment is obviously AI. How's AI going to change the way we work? How's it going to change the investment landscape? And if you can get your head around that, then you can get your head around where you should be investing in the future in the same way we did in the past with these other big changes.
Nick, geopolitical tensions in the Middle East are pushing oil prices much, much higher, disrupting energy markets. How should investors think about that in the context of growth investing?
Look, oil is ex the Iran conflict is in oversupply. Has been for a while. Demand is falling. So oil is probably an industry that is on the downward slope of change, if that makes sense when we talk about change from our point of view. In the short term, this is going to keep oil prices higher, probably for a while, or probably longer than most people think. So it is disruptive, but ultimately it's probably creating an opportunity for medium-term investment from our point of view.
Nick, in the Munro Concentrated Global Growth portfolio, there's about 20 to 40 all-cap growth stocks at any moment in time, of course. Invest in a range of areas of interest, which I've spoke to many people at Munro about before. So lots of macro noise, some powerful structural trends like AI and climate continue to drive markets. How are you positioning the portfolio within those areas of interest, and where's your greatest exposure?
From our point of view, these areas of interest are exactly what I said at the start. Identify your area of structural change, identify your winners. And so the areas of interest are just defining the area of structural change, and within that, we might have 3 to 4 to 5 different types of investments that we think are going to benefit from that big structural change. The biggest area today is without doubt this AI data center buildout. We're very much of the view that the data center buildout is probably closer to the start than the end. We are going through something akin to the Industrial Revolution here, very much an intelligence revolution. Jensen Huang doesn't call them data centers anymore, he calls them AI factories. And I think that's a good term. These are AI factories producing tokens. These tokens are creating intelligence that are going to help agentic workflows. This technology is going to be scaled pretty much across every industry on the planet over the next 10 years. What we're seeing right now is the build out of these data centers to effectively host these agents, to power these agents. And so from our point of view, we would put roughly a third of the fund is invested there today through 3 different areas of interest that we think. One is high performance computing, so the high performance chips that are required to go into these data centers and the supply chain that creates those high performance chips, so that's in high performance computing. The second area we call climate, but you could also call it power. And this is really the electricity that's going to be required to power these data centers. And we're obviously going to see a very large build out of electricity in this area. And so from that point of view, a lot of that electricity will be in a carbon neutral framework because the companies that are spending that money are doing it from a point of very strong internal carbon neutral targets. And the last area we call connectivity. And connectivity is really covering things like networking, how you optically connect these data centers, how you connect them internally to make them more efficient and better. That makes up, those 3 together, despite our bullishness, actually make up about a third of the portfolio today. The other third is in areas that are completely AI agnostic or from our point of view, completely non-correlated. And so that's areas around things like digital media and sports. So sports rights, we like companies that benefit from raising sports rights. So there it's things like Formula One or TKO that Charles has talked about before. And things like healthcare, et cetera, where you have idiosyncratic ideas. And the last third is really just investing in things we think are AI adopters, people who can use this technology to make their business better. And again, that leans back towards healthcare or also things like e-commerce. And so from our point of view, that's how it's positioned today. roughly a third. But from our point of view, most important to have stuff that's not just all AI, because you can get a bit trapped being all AI in this market, because I'm sure we're going to talk about it a lot.
We will. I just wanted to pivot back to the AI factories, as Jensen calls them, that are being built out. Hundreds and hundreds of billions of dollars, if not trillions, being spent on that infrastructure. Who are the beneficiaries of that spending?
The main three areas I just talked about. And I think it's important to flag that, the real question here is this AI spending going to continue? That's basically what people want to know. And a couple of years ago, we would have, we were sort of stabbing in the dark. We're like, this is a big technology and we think everyone's going to use it. And Nvidia's taking off and everything's going great and we think everyone's going to use it. Now, 3 years on, it's blatantly obvious everyone's using it. It's also blatantly obvious it's being monetized. The important thing to flag here is, you've got companies like Anthropic and OpenAI. Their average recurring revenue is now $50 billion per annum. And it's growing at more than 1,000% per annum. At $50 billion per annum, each of them now are both equally top 5 software companies in the world. So software spending hasn't gone away, it's just gone somewhere else. It's gone to the companies that can use this technology. And so you are seeing this return on the investment from those companies. You are seeing the spending continue. And at the rates they're growing at, that's very much early stage. You don't grow at 1,000% near the end of your life. You grow at like 30% at the end of your life. And so these companies are going to IPO this year. They're probably going to be $500 billion to $1 trillion. I think it's going to become very clear that this spending is actually going to continue for a long period of time. So the beneficiaries are the three areas I just went through. And obviously the biggest beneficiary, to be honest, is still Nvidia. 50% of all those dollars still go to Nvidia today. So what Nvidia says and what happens in their supply chain is important. The power side is super important and we think very underinvested. And the connectivity side is very nuanced, a lot more small cap ideas in that part of area. But ultimately we think this spending continues and it's basically going to keep flowing down to these companies over time, which will give you that structural earnings growth, and the earnings growth, as we all like to say here at Munro, gives you share price growth.
Yeah. You talked about Nvidia there, Nick. They've got their conference this week. There's also the OFC conference, so a big week for AI in markets. Lots of attention being paid to those two events. What are you hoping to see from those two events? What are the outcomes you're looking for?
Look, there's basically two things you want. You want Nvidia to continue to show leadership. I continue to create chips that can continue to create tokens more efficiently. Your AI factory gets better at producing intelligence, is the simple way to think about that. And that's definitely something that we expect them to do, and on early indications we see that. The second thing is for those smaller cap ideas. We're looking for those design changes around the data center, around how you may, say, liquid cool them versus air cool them, or how you may use optical rather than copper to connect them, or how you may scale them across, or how you may scale them up. These are all these design changes around these factories, these AI factories, that are really important for some of the smaller cap ideas we have in the fund and also in our small cap strategy.
Nick, we could talk about tech all day, but MCGG is not just a tech fund. As you mentioned earlier, there's other areas of interest. Some people might be surprised to learn that infrastructure is one of those areas of interest. Why do you consider this a structural growth trend?
So 2 reasons why infrastructure is good, because one, obviously we're still in this AI data center build out. So, it's important to understand a lot of people talking about broadening out. Well, if you're going to spend $1 trillion a year on data centers, that's going to flow all the way through the economy. And we see this flowing through, as I talked about, electrical, but you also see this flowing down literally to contractors, construction companies that help build these data centers. The second thing that I think is super important, which is obviously accelerating now because of the Iran conflict, is reshoring. So the reshoring around security spending. We do have security defence stocks in the portfolio, for instance, where we do see the spending, particularly in Europe, continuing for more than a decade. We see continued spending in the US. And then obviously you're going to see this around every country on the planet. I mean, I think people are going to be doubling down on their Iron Dome technology going forward. This isn't going to be a 1-year thing. This is going to be a 10-year thing. And that's not only going to involve defence spending, but it's going to involve reshoring of supply chains. The disruption in the Straits of Hormuz will also make you think about reshoring of a supply chain. The threat around Taiwan will make you think about reshoring your supply chain. And so these infrastructure companies are all leveraged to this. We don't think this is just a Trump fad. We think this is a global phenomenon, and we think it goes for a decade. Nick,
talk to me about managing risk and drawdowns when the market derates long duration equities. I know Munro's got a process, but just take us through it again.
I don't think it's much around derating long duration equities. It's just around managing when you're wrong. I think it's important that, people should understand that we're fund managers, we're not surgeons. We're probably getting half of our decisions wrong all the time. The stock market's not a game of every company wins. The stock market's a game of very few winners and lots of losers. Your job is to find these few winners. They generally revolve around these structural changes. So we identify structural change, identify the winner. But we clearly make mistakes as we go along. And so we run a formalised stop loss process. It's a certain percentage from peak or a certain percentage from cost. We don't have to sell the company. We're just forced to review it. We're forced to question, have we made the right decision here? Should we repitch this investment case internally? What's the thing we might be missing here? And in many cases, we'll decide to keep it. Like we've owned Nvidia since 2018. It's triggered lots of times. I
was going to say, how many times has that been reviewed?
At least 20.
Right.
But we still hold it. But in other cases, we might discover actually we've made a mistake. And this allows us to identify the mistake earlier and step to the sidelines. Or we might decide to manage the position. And if I go back over time, PayPal didn't end up being the super app we thought it was going to be, or Alibaba wasn't the Amazon of China. Or Yahoo wasn't the big internet winner, was it? Or BlackBerry wasn't the big smartphone winner. So these are all mistakes you make. And the beauty of the stop loss process, it obviously pushes you to the sidelines, but it also helps you find the winners. It also pushes you towards the winners are. And so this is very relevant for us even more interestingly. So had we had this interview a year ago, I would have told you software is going to be able to adopt AI and be a big winner of this. But all of our software companies triggered last year. And as we reviewed them and reviewed them, we realised that why are we paying such high multiples for companies where we're not really sure how this is going to turn out? And so we ultimately chose to step to the sidelines. Come 2026, we thankfully have no software companies. And so that's that process in action, just helping us make the right decision to avoid the pitfalls in markets, because markets are as much about avoiding your mistakes as they are about finding your winners. And this process helps us avoid mistakes, but also pushes us towards the winner.
Nick, we're chatting as part of Livewire's listed series, of course. Why offer the strategy as an ETF?
Yeah, it sort of comes back to the purpose of Munro. Munro's job is to be your global growth manager. That's why we set up the business. We want to be your global growth investor. As a managed ETF, you can wake up today, you can buy MCGG, and tomorrow you'll wake up and you'll own 20 to 40 of the best growth companies we see in the world today. These are the companies that we spend a lot of time researching around all these areas of structural growth to find that structural earnings growth, and that structural earnings growth should give you share price growth. And so our job is to find you the best 20 to 40 companies in the world. And the other beauty of the ETF is the day you don't want it anymore, you can sell it and you get your money back. It will always be daily priced, it will always trade at NAV. You're not stuck in anything, there's no gates that are going to come up, etc. And so from our point of view, we think it's the perfect vehicle for providing what Munro is being built to do.
Yeah. Nick, $1 million question. How should investors use MCGG in a portfolio over a full cycle? And then how would they test that the thesis is still on track?
So from our point of view, we're trying to find areas of structural growth. That structural growth should equal structural earnings growth. Every company we invest in is usually growing its company earnings at least 15% per annum. And so lo and behold, if these stocks follow their earnings and we manage risk accordingly, our funds do roughly 15% per annum. That would be the mid-cycle. Double digits would be, the minimum of what we'd be looking to achieve through the cycle. Last thing we just say is that obviously we run to a beta budget or a volatility budget of roughly 1.2 in this fund. So it will be slightly more volatile than your other investments. And so every investor should obviously take their own financial advice. That's not our job. But you should hold Munro Munro Concentrated Global Growth as part of a balanced portfolio.
Nick, thanks for taking us through that.
Thanks very much.
If you enjoyed that conversation, make sure to give it a like and don't forget to check out the rest of the listed series content available on the Livewire Markets website.